Okay, everybody, we're at 9:45. We're going to switch over to the Chapter 12 class notes. While you're transitioning, I'll give you guys about 3 minutes to work on the questions and transition over. And so in 3 minutes, we'll go over the answers to the practice questions. Sorry, I didn't bring you one. So make a little note on the group project that is due November 26th. It has to be uploaded or dropped off at my office before midnight. Okay, so we are working on Chapter 12, corporations, organizations, stock transactions, and dividends. So there's a lot to cover in the chapter, but it's only surface deep. So we're not really digging down into the difficult stuff. We're just getting the basics. So which of the following is not a characteristic of a corporation? The financial loss a stockholder may suffer from owning a stock in a public company is limited. So that's actually true, right? That first one there, A. Basically, what you invested in the stock is the only amount that you can lose. Cash dividends paid by a corporation are deductible as expenses by the corporation. And that one is incorrect. So the answer is B. Cash dividends are not an expense, they're a transaction with ownership. Those most responsible for the major policy decisions of a corporation are, and here they're talking about sort of what do we want to do for a business, how do we want to do it kind of thing, not what's going to be happening day to day or month to month. And so that answer is the board of directors. So the excess of issue price over par of common stock is termed premium. and it'll be recorded in what's called paid-in capital, or additional paid-in capital, sometimes you'll see it called. The price at which a stock can be sold for depends on a number of factors. Which statement below is not one of those factors? How high the par value is, and that is the answer. These other things, the financial condition, earning record, and dividend record of the corporation would help you price the stock. Investor expectations, the corporate earning power. You know, if they expect it to be able to earn more in the future, they're going to pay more for the stock. General business and economic conditions. We talked about interest rates and how the economy is doing. That will affect corporations more than most things. The liability for a dividend is recorded on which of the following dates? And so the answer is D, the date of declaration. And we'll talk more about the important dates for dividends as we go on. So again, I got your feedback that some of the writing was too much, but I want you to be able to see these definitions. I don't know whether or not you're all reading the text carefully. So please make sure you understand, you know, what a corporation is, what stockholders are. Corporations are legal entities distinct and separate from the individuals who create and operate it. So if I'm going to open a small business, I can open it as a corporation and it be separate from me. But the second that I intermingle my finances with that business, then it becomes no longer a valid corporation in terms of the things that we see, the separate and distinct. So now they could go after the owner's personal assets. But if you run it like a corporation and you keep the personal assets separate from the corporation's assets, then they can't go after you. And for stockholders, they can almost never go after you unless you stole from the company somehow. All you can do is lose your stock if the company decreases in value. Okay. Some of these we talked about early on in the class when we were talking about what's a corporation and what are we studying. And these are just some quick notes on the advantage. So separate legal existence. Corporations exist separately from owners. Continuous life. So the expectation is that a corporation has indefinite life. Corporations can raise large amounts of capital by selling stock and debt on public markets. Ownership rights are easily transferable, so stocks are easily purchased on a stock exchange. So you guys are familiar with stock exchanges? There's kind of two here in the United States that are the main ones. You have the New York Stock Exchange, NYSE, and NASDAQ, but there are stock exchanges throughout the world where stocks can be bought and sold. Limited liability. A corporation's creditors cannot go beyond the company's assets to satisfy legal claims. I'll give you a minute to write that one down. We see it all the time when corporations can't pay their bills. Corporation goes bankrupt. I can't remember all the codes, but you have different types of bankruptcies. You have Chapter 13, Chapter 11. Some of them allow them to continue as an organization, and then others are strictly liquidation. Sorry if I didn't give enough people light in the back there, and I'm kind of washing out the screen. All right, so those are some of the advantages. There are more, but those are the important ones. Some of the disadvantages: owners are separate from management. So management controls the company. And is closely tied with the board. This may result in management making decisions not in the best interest of shareholders. So we call it information asymmetry. Management knows what they're doing. They know what their plans are for the organization. As an owner, you only get what they disclose publicly. So management can be doing things behind the scenes that hurt shareholders unbeknownst to those shareholders. Double taxation of dividends. A corporation pays taxes on its profits, and then dividend holders pay taxes on dividends. Sometimes they can receive special treatment for those dividends if they hold it long enough. And you get a slightly lower tax rate, but that's for tax class. And so regulatory costs are specific to public companies. You don't really have too much if you're a private corporation. You still have to do filings and taxes. But for public companies, they have to satisfy the reporting requirements set by the SEC. So the SEC is the enforcement body and the rule maker for public companies. They were created in the 1930s after there was a huge collapse of the markets. And so what they did was they put in place a body that could regulate what public companies were reporting because it wasn't that reliable. Come 70 years now, and we have some more breakdowns. Technology creates things that we had never seen before. And so Sarbanes-Oxley was created to help, again, ensure financial reporting was better than what was happening because we had another meltdown due to fraud and poor reporting. So regulatory costs are a big cost for corporations. Corporations spent millions of dollars on the financial statements. I mean, we have a whole industry you're learning in this class. If you go on to be an accountant, you'll have 5 more classes just on the financial side talking about what we report to the outside. So regulatory costs are expensive, and Sarbanes-Oxley and the public reporting requirements are the main cost of those two things. So we're going to talk about some terms related to forms of stock. So that first part of your chapter, it just kind of talks about what corporations are. So now we're moving kind of to the second objective, and we have to account for stock. So there's a couple things, or a few things that you should know about the terminology with stock. So the first thing is authorized. This is the number of shares the board has authorized the company to be able to sell. I'm sorry, issue. Sell is the same thing, but issue is the appropriate word for stock. These are shares sold and held by shareholders and outstanding are shares issued less shares repurchased by the company. These are called treasury shares. And they are not retired. So a company has a couple choices when they buy back stock. One, they can just keep a record of it on their books. And when they do that, it's called treasury stock. So it's recorded in the accounting records. The stock is still technically available to be bought and sold, but they own it. And so they can reissue that stock. A lot of times what they do is they'll do it in employee compensation plans. So they'll say, we bought this stock on the market. We have employees that are going to get $10 million in stock. We're going to give them that stock. Now, you as a shareholder look at that and go, well, that's not bad, right? Because though they're compensating their CEO with stock, and we've seen stock compensation go up massively, right? Before, CEOs used to make 20 times what employees make. Now CEOs make 200 to 300 times more. It's because of that stock compensation. And so if you're an investor, you see all this stock compensation going to management, and you'd say, hey, that's diluting my shares, right? Shares are about supply and demand. If there's 1 million shares out there, they might be worth $10. But now if there's 10 million shares out there, they're going to be worth 10 cents, right? Because that's how we value the corporation. And so if they use those shares that they bought to compensate it, then as an investor, it doesn't hurt you. So they're buying back shares from the market. At the same time, they're often either giving these shares out or issuing them. Now, when I make a note here that they're not retired, the other thing that a company can do is it can buy shares of stock and then eliminate them by retiring them. So that takes it off the books completely. And that's slightly different case scenario. Any questions about those 3 important terms? Let me just pull up a financial statement and kind of give you an idea of what that looks like. So this, by the way, I try to show you guys this, but this is Apple's financial statements. They're 56 pages long. So our financial statements, even though they're kind of at the heart of it, are only a few pages out of that whole thing. Okay. So on the balance sheet, this is what it looks like. So it'll say common stock and additional paid in capital. So that 0.00001 par value, how that gets so small is that what happens is when the stock splits, it reduces that number. So if I had, before I was talking about 1 million shares, if they were at $1 par, if I go up to 2 million, then that par drops to half. So that's why that par value keeps going down. So they have 50, I don't know, it's probably in millions, probably 50 billion shares authorized, 15 and 15 issued and outstanding respectively. And what they're telling you is that's for the respective years. So this would be for this year and then the other year that's presented. And they lump it all in together. I haven't seen it presented like that, but this is both common stock and their paid in capital. Now, they don't have any other classes of debt. I'm not sure, excuse me, of stock. So hopefully we'll see some more of that. So that's an important note. Now we're going to talk about types of stock. And so common stock is also called capital stock. And what it is the voting and ownership stock of the corporation. Most of the time. Companies have recently started issuing common stock that has no voting rights or less voting rights. So if you buy Alphabet, which is Google, there are two types of stock that you can buy. Actually, I take that back. There are two types of stock out there. I don't know that you can buy both of them. One is supposed to be for insiders, and it's got a higher voting number on their shares. So their votes count more than yours. And that's how Zuckerberg, he owns, I think, 16 to 18% of Facebook or Meta, but he's able to control 51% of the voting. So these tech companies are starting to do that where they issue two classes. Prior to that, common stock was always, if you have it, you're able to vote, you're able to receive dividends if they're declared. So then here's some other terms. So stock with no par value. If you have a stock with no par value, then you would report it as one number, similar to the way Apple did. If you have a par value or a stated value, these are largely assigned based on state regulations. And you'll see some out there that go from $1 to, that one's, 1/10 of a penny or 1/100th of a penny. All right. Most of the time they don't mean anything. A few states have restrictions that say if your retained earnings isn't above this amount that you can't issue dividends or buy back things from investors. So there are some small restrictions. Most corporations aren't affected by it. Paid in capital is the additional amount you receive when the stocks have par or stated value that is above that par or stated value. The second type of stock that we're going to talk about is we're going to talk about preferred stock. And this type of stock has characteristics. A little brain fart on how to spell it. Make sure I get it right. More like debt. The holders have priority over assets versus common stockholders. So that means if the company goes into bankruptcy, in the line to get paid, you are behind the debt holders, but you are in front of the common stockholders. So a lot of startup companies like to use preferred stock because it means that their owners will be in line before the common shareholders. Plus, there are features on preferred stock that you can convert to common stock. And so there's lots of different features that are for that stock. So first preference over common stock in receiving dividends also. Now they have different types of preferred stock. One is called cumulative, and this means that dividends accumulate if not paid. The corporation, if they declare dividends, must pay these dividends first. Non-cumulative is the next term, and these are dividends do not accumulate. If dividends aren't declared, then there is no obligation to pay them in future years. Convertible. So this is where I talked about preferred stockholders can convert their preferred stock into common stock. And then terms vary by the type and agreement of preferred stock. So they can say that it's convertible into 10 shares, it's convertible into 2 shares, whatever the face of the bonds says. Callable. The issuer can recall the bonds. Oh no, I'm sorry, preferred stock. Keep saying bonds, but they behave so similarly to preferred stock. And pay off the preferred shareholders. Again, terms vary by the agreement. Okay, I'll give you a minute to catch up on that writing. If anybody has any questions, please don't hesitate to ask. Okay, the last category of stock that we're going to talk about today is treasury stock. And this is a company's stock that has been issued and repurchased by the company. Little note there, for treasury stock, the company doesn't receive dividends on that stock. So when we are talking about dividends later, it will only be paid on those shares that are outstanding, and treasury shares are not considered outstanding. So we have three types of stock and what's some of the entries. So common stock, if there's no par or stated value, you would debit cash or other asset, and then you would credit common stock. There is a par value. Then you would debit cash or other asset. You would credit common stock. And this would be for the number of shares times par value. And then you would credit paid in capital for common stock. And this would be for the difference. Preferred stock. Debit cash or other asset. Credit preferred stock. Again, so if it has par or stated value, and they'll almost always has a par value. So you debit cash, credit preferred stock, or the par value times the shares, and then credit paid in capital for preferred stock. And this would be for the difference. So treasury stock operates as a contra equity account. This means that the amount in treasury stock reduces equity. And the entry would be debit treasury stock and credit cash or other asset, whatever you had to give up to get the treasury stock. And then to sell treasury stock, debit cash or other asset and credit treasury stock. So you'll notice here that treasury stock is a debit, whereas all the other ones are normally a credit. And again, that's because it's a contra equity account. So hopefully that's given you a good base to talk about example 1. And I will walk us through it. So we want to prepare journal entries to record the following 4 separate issuances of stock. All right, so number 1, a corporation issued 4,000 shares of $5 par value common stock for $35,000 cash. So we're going to debit cash because we got $35,000. We're going to credit common stock. And we had 4,000 shares times $5 par. So I think that's 20,000. Somebody check my math. Thank you. And then you'd have paid in capital. And I'm going to abbreviate here, but that's common stock. And that would be for the difference. So 35,000 minus the 20,000 gives us 15,000. Okay. Any questions on that one? Number 2, a corporation issued 2,000 shares of no par common stock to its promoters in exchange for their efforts, estimated to be worth $40,000. Excuse me, the stock has a $1 per share stated value. So this would be like advertising or promotion expense for 40,000. And you'd have common stock. And this would be 2,000 shares times the $1 par. And so that's 2,000. And then you have paid in capital for common stock for the difference of 38,000. Okay. Now, a corporation issues 2,000 shares of no par common stock to its promoters. So advertising or promotion expense. And then you would just have common stock, and they're both going to be 40,000. Any questions so far? Okay. Corporation issued 1,000 shares of $50 par value preferred stock for $60,000 in cash. So we're receiving cash. And that's for 60,000. And we're selling preferred stock. And this is 1,000 shares times 50 par value. And so that should be 50,000. And then we have paid in capital for preferred stock for 10,000. Okay, I'll leave that up so that those of you can finish copying. I see somebody struggling back there with sight, so I'm gonna make it a little bigger. I won't say who, Kirsten. You can always ask, remind me if I don't have it big enough for you. And for those of you that have this down, you can start on practice question number 1, and I'll go through it in about 2 minutes. Do you have any questions about what we covered so far or this practice question? Let me know. She'll tell you about Massachusetts people. A little sketchy. So good to see so many of you working on it, trying it. I appreciate that. Okay, so what did we get? Cash, right? And 648,000 is correct. We sold 36,000 shares at 18 per share. And so that's $648,000. And then you'd have common stock. And this would be 36,000 times 2 par. And so this would be 72,000. And so the difference would go into paid in capital for common stock. Thank you, Ben. 576,000. Now, this entry is going to be the same for both of them. because par value and stated value are essentially the same. Bless you. If you did not have par value, you'd have cash would be your debit. And that would be 648,000. And your credit would just be to common stock for 648,000. On to example 2. So it says, prepare the issuer's journal entry for each of the following separate transactions. So each one of these is going to be independent. So for scenario A, Atlantic Company issues 42,000 shares of par value of $4 par value common stock for 297,500 cash. So we have cash, 297,500. Common stock, 42,500 times $4 par. And I have 170,000. And then I had paid in capital for common stock. And that's the difference of 127,500. The no par ones are always easy. Cash, 70,000. Common stock, 70,000. Okay. Next one, some fun stuff. I wanted to show you one that you got some assets for the stock that you issued or reissued out of treasury shares. So on April 6th, MPG issues 2,000 shares of $25 par value common stock for $45,000 of inventory, $145,000 of machinery, and acceptance of a $94,000 note payable. So we're getting inventory, 45,000. We're also getting machinery, and that's for 145,000. They accepted a note payment from us. So we have a note payment payable, sorry, for 94,000. And then we have common stock. And the common stock, we issued 2,000 shares times 25 par. Thank you. 50,000. And then now we have paid in capital for common stock. And this is sort of the plug or difference. So we know when we add this up, the 145 and the 45, that's 190,000. So we subtract the 94, that leaves us with 96. We subtract the 50,000 and we end up with $46,000 of paid in capital. Mushing onward. Example 3, Prepare the journal entry to record the issuance of 5,000 shares of $100 par value, 7% cumulative preferred stock for 102 cash per share. Remember, when you see that 102, remember that's 102%. So we're getting cash and we're selling 5,000 shares times 100 par times 102, 1.02. And we end up with 510,000. Then we have a credit for preferred stock. And this is the number of shares, 5,000 times 100 par. And that's going to be 500,000. And then you have paid in capital, preferred stock for the difference of 10,000. Okay. So now it says, assuming the facts in part one, it declares a year-end cash dividend. What is the amount of the dividend paid to preferred shareholders? Assume no dividend in arrears. So we have face value, 5,000 shares times 50. Oh, no, I'm sorry, this is $100 par. And then we multiply that by the interest, right? 7%. And that equals 35,000. So our entry is going to be retained earnings. And just note, sometimes you'll see dividends, a contra retained earnings account. For 35,000, and then you'd see preferred dividends payable for 35,000. And then when paid, you debit preferred dividends payable and credit cash for 35,000. So that is this 102 right here. That just means you multiply by 1.02. So when you sell bonds or sometimes with preferred shares, they'll tell you you received 100, that would be 100%, so the face value. If they tell you received more than 100, you got a premium on it. If they tell you received less than 100, then you got a discount on it. Really wanted to give you guys Tuesday off. I haven't gotten far enough. All right, I'll let you guys the choice. Do you want to work on your group project on Tuesday and take the day off, and then I'll finish 12 and 13 in the last week? Or do you want me to come to class on Tuesday? Close your eyes. All right, everybody close your eyes. Nice and tight. All right, raise your hand if you want me to come to class on Tuesday. All right, never mind. Well, we don't need to go to the second one. All right. So I will see you Tuesday after the break. Work on your group project, and please make sure you turn it in. Either drop it to my office on Tuesday or turn it in online, and we'll pick up here on December 3rd.